I know you will be the best off in 10 years and have the most wealth because of the lowered risk and the increased peace in your life is if you were debt-free.
So I came across this video, and Dave Ramsey's advice to this caller, let's just say deserves a second opinion.
Fresh eye never hurts.
So in this video, we're going to listen to the caller's problem, and we're going to compare two scenarios where we apply Dave's advice and another scenario where we apply an alternative solution. Then we'll see which one is best for the caller. Hey friends, my name is Adrian and welcome back to the channel. Now, we don't normally do reaction videos, so if you enjoyed this one, please let us know in the comments below. Okay, if you don't know who Dave Ramsey is, he is a very popular radio personality. His company, Ramsey Solutions, helps people take control of their financial lives and be debt-free. Now that the introductions are settled, let's get into the video.
I was calling because I had a question. I have $6 million worth of property here in the area, and almost $3 million, about $2.8 million in loans. Do you think it's wise to sell some of my portfolio to pay off the loans and be debt-free, or should I utilize the monthly cash flow to pay off the loans fast?
Well, congratulations. You've done a good job. You got a good equity position, and you've obviously got a going concern. There's a lot of different ways to attack the situation where you are. You can keep doing more of what you've been doing. Here's what I learned when I had, when I was 25 years old, 24 years old, I had $4 million worth of real estate, and I owed $3 million on it. So I did not have as good an...
Okay, Dave does this a lot, and it's very important why his advice is dangerous. Remember his story because we'll be coming back to it later in the video.
An equity position as you do. Okay, I was about 75% loan to value. You're about 50%. All right, but I ended up losing everything because the bank got sold to another bank, called our notes. We had a lot of flip notes out at 90-day notes, and it caught me and took me out.
So apparently Dave took a lot of real estate loans in his late 20s, and he was over-leveraged. The bank called his loans, and he had to file bankruptcy.
And what I learned from that going broke process in my 20s 30 years ago was that those of us that love real estate, people like you and me, Christian, sometimes we forget to measure risk. Common sense tells you, and actual business analysis tells you, that the more debt you have, the more risk you have. Would you agree with that?
Yes, indeed.
Okay.
If he is referring to the more leverage you have, for instance, a 90% loan-to-value ratio, then yes, I agree that is a very risky position. But if he means the more individual loans you have, the more risky you are, then I disagree. Because if you have a high debt service coverage ratio, or DSCR, then you give yourself enough cushion before you get into trouble. DSCR is simply a measure of your ability to pay the debt. Solving for the DSCR is simple. It is DSCR equals net operating income divided by the debt service. So if your NOI is $10,000 and the annual debt service is $10,000, the DSCR is 1. This means to the bank that the property or business is generating just enough income to break even. That is why most banks require a minimum DSCR of 1.25. So using our previous example, the NOI must be at least $12,500 to meet that requirement. And if you can find ways to make the DSCR even higher, the lesser of a risk you are in the eyes of the bank, therefore increasing your chance of getting the loan.
And what I've discovered now over 30 years, not only of teaching these things, but of living a completely debt-free life, and I today own several $100 million worth of real estate. What I've discovered in that process, building that portfolio a different way over this 30 years, is that the lack of risk with having no debt has accelerated over the long haul the amount of real estate I can own. Because
the question you should ask here is compared to what? Let's use a simple example. If you're the only vehicle traveling on the freeway doing 40 miles per hour, in your mind you might be going fast, but you'll quickly realize you're actually slow when there are other cars doing 60 or 90 miles per hour.
I miss you, Mama Speed! Ricky Bobby's back!
Wait, how fast is he going?
26 miles an hour.
What are those things? Were those the other cars?
If we're simply talking about buying more properties, then it is a no-brainer that using debt will acquire more properties than purchasing without it. Because the very purpose of debt or credit is to increase your buying power. Let's say there are two investors with $1 million to invest. If both are trying to buy a $1 million property and investor A pays all cash, he or she can only buy one property. But if investor B uses debt with 25% down for each property, he or she can buy 4 properties instead.
Personal walk and from walking with others is that where I know you will be the best off in 10 years and have the most wealth because of the lowered risk and the increased peace in your life, it is if you were debt-free. Now, do we have to burn everything down and do this suddenly because you and I had a conversation? No, I think you have a gradual process and you say, okay, over a year, 2 years, 3 years, whatever it is, I'm going to move in that direction. Because if I were in your shoes, I would rather have $4 million of paid-for real estate than $6 million of real estate with $3 million worth of debt.
Okay, that's a risky advice. And to be clear, he's not the only one doing this. But when you're giving advice, you should be objective. In the past minute or so, he says, I know, or if I were you. Because remember earlier in the video, Dave mentioned that he had a bad experience with debt. He got wiped out. So moving forward, he swore to never use it, not even a credit card.
I don't own a credit card. I haven't owned a credit card in 20 years.
So let's go ahead and apply Dave's recommendation and see if it is actually the best move in terms of investment decision making. All right, recall that Christian lives in Greensboro, North Carolina. His portfolio is $6 million and he owes $3 million. Christian's question is option 1, do you think it's wise to sell some of my portfolio to pay off the loans and be debt free? Or option 2, should I utilize the monthly cash flow to pay off the loans fast? And we can see Dave's recommendation here is to have $4 million of paid off real estate in 3 years. So it's selling $3 million worth of property to pay off $3 million worth of debt. Then the remaining properties appreciate by $1 million. So it seems like Dave is choosing the first option here. In order to calculate the cash-on-cash return, we need to know the rents. Here is a map of available rental properties in Greensboro, North Carolina. Now, we don't precisely know where Christian's properties are, so for the sake of argument, let's pick this area here. And let's say the median rent in the area is $2,000 per month. Let's do a simple calculation. The income is $2,000 per month, times 12 to get the annual value. Let's say he has 10 properties. Let's assume it's 10 because the median home value in the area is around $400,000. For expense, since he has no debt, his expense ratio is around, let's say 30% because he still has to pay taxes, insurance, and set aside money for reserves. The annual cash flow totals to $168,000. To solve for the cash-on-cash return, just divide the annual cash flow by $3 million. Let me fix the format here. Okay, so it's 5.6%. Now the question is this a good return? With the effort and the amount of risk that comes with the investment, is this return good enough? 5.6% return and Christian will still have properties to manage. And Dave knows all about property management.
There's nothing passive about managing real estate. Nothing whatsoever. You want passive, buy a mutual fund. They'll just put the check in your mailbox and you don't have to think anything about it. But real estate ain't passive. It's very active. Even if you're managing the managing company, they've still got to call you and approve the $8,400 new heating and air system that blew up.
So what are the alternatives? Where Christian can put the $3 million with comparable returns, but with less risk or effort. Well, how about a certificate of deposit? What about the 30-year treasury bond? Yes, it's 130 basis points lower, but you're not managing any tenant and there's barely any risk.
Those of you that are playing with real estate or want to play with real estate, let me just tell you something. You will never put in, you will be less likely, you can always do something stupid. You will be less likely to put a bum tenant in a property when you don't have any payments. But when you got payments, you're looking for somebody to pay those payments with their rent.
It's a very good
and
point.
you're more desperate as a landlord to fill your vacancies, and you're more likely to go, well,
Debt or no debt, it is smart landlording practice to vet the tenants you're putting in your properties. Your financial obligations to the bank has nothing to do with how you run your business.
but you won't overlook that if you're going, I don't think unless you really make me feel good that I'm going to let you have the privilege of living in my property because I don't
That's a
have
good
any
point.
problems now and I don't need you to bring your problem.
Did you catch that?
Really make me feel good that I'm going to let you have the privilege of living in my property.
For those of you wanting to own your first rental properties, please don't let your feelings decide whether to approve or deny a tenant. In fact, your emotion will get you in a lot of trouble. Create a standard or objective criteria as a screening tool. There's so many resources out there and it's different for every state. Some of them are, their income should be 3 times the rent, their last 3 pay stubs, credit check, background check, referrals from previous landlords, and etc. Now, I contradicted a lot of points that Dave made, but let me be clear. His methods are a way of getting financially ahead, but it's not the way. Also, his advice has helped a lot of people get out of debt. You see, investors like Dave Ramsey and Susie Orman have a very similar style of investing. It's like playing the game not to lose. They play a lot of defense and very little offense. While guys like Sam Zell, Trammell Crow, and Barry Sternlicht, they play to win. They're not afraid to take calculated risk and play with a lot of offense.
Best defense is a good offense.
So Dave mentioned earlier that investing in real estate is not passive, but he's only partially correct in that regard. Because having no debt on a property doesn't mean no responsibility. There are still tenants living in that property and something will eventually break. Now, if the caller wanted a totally passive real estate investment with excellent tax advantage and no responsibilities, then investing as a limited partner is one of the alternatives. So if you're interested in learning how that works, go ahead and click and tap this video here, where I explain the main differences with investing in residential or commercial real estate.